Hi, my name is Alex Carlucci with GustanShow.com. Breaking news today, Fed has cut interest rates. What that means is they have cut the overnight rate that the Fed lends money to banks to keep their deposits at a certain minimum requirement. It does not mean mortgage rates were cut by a quarter. It does mean that the prime rate was cut by a quarter, which does affect some mortgage rates, but not the 30-year fixed and the 15-year fixed. It affects the home equity line. So the 30-year fix is pretty much the same as it was this morning after the Fed cut. They're a little creep down in the credit. Maybe you might have the same rate, but maybe you get a $100 closing cost credit from the lender because of the small move that happened since the rate cut. So let me explain what the Fed's doing. So when they cut rates, they're trying to thwart off a recession, or they're trying to stimulate the economy, or they're predicting that something bad down the road's coming and they're trying to keep the market stable. So today they said that the global worries about like China and Europe and the trade war were worrisome enough, along with the fact there's no inflation in the economy, to lower the rates. Now, inflation is running below 2%. That means they don't want to raise rates of inflation. If inflation is running at 3%, 4%, they're going to raise rates. If inflation is running at 1% to 2%, they want to keep rates low because it stimulates the economy. And the reason when they keep rates low, it stimulates the economy, is because it creates so many jobs. When rates are really zero, the economy really starts booming. Mortgages are going, car buying's going, a lot of things happen in the economy, and it trickles through the whole economy. And the reason they don't keep it zero forever is because the economy can get so hot that now people have so many jobs that there's no jobs out there, that people start asking for raises because their employees are in such demand, and there's lack of supply of employees, so people start asking for higher wages, and the cost of goods go up, the cost of your car goes up, the cost of milk goes up, and they have to stop that by raising rates. So they raise rates to stop inflation. They don't want the price of goods to get out of hand faster than the wage growth. So that's what they're trying to control when they're doing the rates. They don't actually try to control mortgage rates necessarily, but they are affecting what the economy is doing. So right now they said inflation's low, and the risk of a global slowdown is the risk enough to lower the rates to thwart a future problem. So right now there's nothing really wrong with our economy. It's really the global. So the global economy, we're all in a global world now. It's not just local anymore, so we are watching what happens in other countries. And that was the reason, because in Europe they're having a little bit of a slowdown, China's a little bit of a slowdown. We have to keep pace with them. They're lowering their rates there, we have to keep our rates low with them. So that's what's going on with rates today. That's breaking news. If you got any more questions, go to GustanShow.com or give me a call, Alex Carlucci, 630-915-7550. Thank you.